Welcome back to the Deep Dive. Today we're digging into a really critical X-ray of the world's balance sheets, and it comes straight from the latest report from Trading Post. We're going to unpack this relationship between, private sector debt, U.S. dollar liquidity, and what it all means for the business cycle and, of course, for your investment strategy. And Trading Post flags a huge concern right away. High private sector debt can be a massive drag.
And China is the poster child for that, really.
Exactly. And they link this leverage directly to the availability of U.S. dollar credit.
Right. And what makes this analysis so valuable is the data they're using. It's from the Bank for International Settlements, the BIS.
So that's the gold standard.
It is. It gives us a really clean view of private credit loans, debt instruments, all of it in local and foreign currency.
And to be clear for you, the listener, we're talking purely about debt here.
Mm.
So this excludes things like equity, private equity fundraising.
Mm.
We're just focused on who owes what.
Precisely. It's all about the liability side of the private sector's ledger.
Okay, let's unpack this. The story of all this debt is, well, it's really tied to the QE era in the U.S., isn't it?
Inextricably, yeah. When the Fed held rates at zero for so long, the rest of the world just jumped at the chance to borrow dollars for next to nothing.
Oh, its scale of this is just, it's staggering.
It's an explosion. I mean, over those 13 years of QE, from the first quarter of 2009 to early 2022.
Right before the Fed started hiking.
Exactly. U.S. dollar borrowing by the rest of the world more than doubled. It went from $5.8 trillion to $13.4 trillion outstanding.
That is a huge spike. And Trading Post points out that nearly half of that was issued as dollar bonds.
And that's a critical detail because bonds, unlike bank loans, are, well, they're less transparent.
Harder to restructure.
Much harder to restructure and easier for investors to just dump quickly if things get scary.
Right.
It spreads the risk, but it also makes the system more brittle.
So we have this massive kind of rigid pile of dollar debt out there. But at the same time, the dollar started getting stronger from 2011 on. That's the core risk, right? Why would anyone, especially in emerging markets, keep borrowing in a currency that was getting more expensive to pay back?
Well, it was a fascinating gamble on the currency mismatch. The thing is, borrowing at home in their own currency was just dramatically more expensive.
So it was an arbitrage
A
opportunity.
huge one. They were basically betting that the high cost of borrowing locally was a bigger risk than the dollar getting stronger.
And what was the offset? How did they think they could manage it?
Strong global growth. Export revenues, which are, earned in dollars, were climbing by an average of 6.4% a year.
So on paper, it looked manageable.
It looked manageable. It was a calculated risk that worked right up until export growth slowed down and the Fed hit the brakes.
And who was leading this charge?
It was the EM non-bank sector. And within that, firms in Asia were overwhelmingly the biggest borrowers. They accounted for over a third of all that global dollar credit.
Okay, so that tells you where to look for the pressure points.
Absolutely. When the trade cycle wobbles, that's where you feel it first.
So the world loaded up on cheap dollars. Then rates went up. Let's look at where we are today. How do those balance sheets look now?
It's actually surprisingly resilient. Trading Post shows that debt to GDP ratios have, for the most part, declined across advanced economies and most of Asia.
They've come down from the peaks in the early 2000s.
Exactly. But there's one glaring exception, the outlier that really dominates this entire report.
China.
China. While the ratio has peaked and fallen in the US, Europe, Japan, China's has just kept marching upward, from about 191% to just under 202% by early 2025.
And that's driven by the corporate sector, not households.
Overwhelmingly, yes.
Okay, so when Trading Post sees these high debt levels, they check two things: the pace of the borrowing and the cost to service it. Let's start with the pace. Are we in some kind of credit bubble?
This is where their technical analysis is so key. They use a standard check for a credit bubble, seeing if the private credit to GDP ratio is more than 2 standard deviations above its long-term trend.
Right, that's the classic signal of malinvestment, like we saw before 2008.
That's the one.
And are we there now?
The analysis is definitive. No.
Really?
Nowhere in their entire universe of countries is that ratio above the +2 threshold, which raises a really important question.
Which is?
If this isn't a classic bubble driven by super low rates, then the focus has to shift completely to the second factor. Can the private sector actually afford the debt it already has?
The debt servicing costs. That's measured by the debt service obligation, or DSO.
Correct. That's interest plus amortization as a percentage of income.
And there's a huge range, right? Korea at the top with 20%, Indonesia way down at 4.5%.
Yeah,
But you have to split this out.
you absolutely have to. The picture just changes completely when you separate households from corporations.
So what do households look like?
They look incredibly robust.
Right.
For the US, the Euro area, Japan, those debt servicing ratios are all in the single digits. Korea is the only high one at 11.5%.
And given that the IMF doesn't really worry until that number hits 40%, this means households are, broadly speaking, fine.
They are not a stress point, not at all. Many locked in low-rate mortgages, which protected them from the Fed's hikes.
Okay, so that's the good news. But then we get to the corporates. Their DSO ratios look much, much higher. You see 39% in the Euro area, 35% in Japan.
And that is why Trading Post insists you can't use that metric for companies. You have to use the industry standard, which is the interest coverage ratio, or ICR.
So instead of income, you're looking at profits.
Exactly. Earnings before interest and taxes divided by your interest payments. It asks a simple question. Are your operations generating enough cash to pay your creditors?
And the rule of thumb is anything below 1 is a huge red flag.
Giant red flag. It means you're borrowing just to pay the interest on your existing debt. Above 2x is considered healthy.
And the data says.
The good news is that for the US, Japan, Malaysia, India, the aggregate corporate ICR is comfortably above 2x. It signals real resilience.
We have seen corporate insolvencies rising in the EU, haven't we? Germany in particular has been hitting new highs. Doesn't that contradict the healthy average?
That is the critical challenge to the whole bullish story, and Trading Post acknowledges those figures.
So what's their take?
They argue the stress is concentrated in specific sectors. They don't see this turning into a uniform, systemic corporate debt crisis in Europe.
So it's a cleansing of zombie firms, not a sign of a collapsing system.
That's their argument, yes. They believe the broader business cycle is strong enough to contain it. But for an investor, that divergence between the healthy average and sectoral stress is, well, it's everything.
So if most of the private sector is in decent shape, we have to pivot to the big exception.
You do. Corporate China.
Trading Post calls it a black hole.
And it's a perfect term for it because you can see the gravitational effects on the surface, banks constantly needing support, but you have no reliable, up-to-date data on what's actually happening underneath.
No clean data on insolvencies or debt servicing like we get from other countries?
Nothing. So you have to rely on signals.
And what are those signals telling us?
They're all pointing in one direction. Considerable sustained pressure. First, corporate liabilities just keep rising. Second, banks are restructuring loans on a massive scale.
Which is basically an admission that the original terms can't be met.
It is. Third, the central bank, the PBOC, has rolled out one special credit facility after another just to support these stressed borrowers.
So they're propping up the system.
Constantly. And you combine all that with a profit cycle that's clearly in a downturn. It paints a pretty grim picture. High debt, high rollover risk, and low profitability. It's the biggest single drag on global growth.
Okay, let's switch back to U.S. dollar liquidity because there's a really surprising trend here that seems to point in the other direction. After the Fed started hiking rates in March 2022, demand for dollar credit fell off a cliff.
It did, but only for 3 quarters.
Which is amazing.
Yeah.
By mid-2023, dollar borrowing was rising again, even with the Fed funds rate at its peak.
And as of the second quarter of 2025, U.S. dollar credit to the rest of the world was growing by a pretty robust 6% year over year.
So why isn't Trading Post worried about this? I mean, a resurgence in borrowing at high rates seems risky.
They actually see it as a positive sign, as a return of risk appetite. And they point to 4 factors that make this different from the old QE era borrowing.
Okay, what are they?
First, it's recovering from very low levels, so the pace isn't alarming. Second, and this is critical, the dollar has depreciated quite a bit this year.
Which gives every foreign borrower an immediate break on their payments.
An immediate easing of pressure. Third, export earnings are stronger, especially in Asia, which means more dollar income to service that dollar debt.
And the fourth?
The Fed is now officially in an easing cycle, so everyone knows that funding costs are, gradually going to come down over the next year.
It's just a testament to the dollar's power, isn't it? The world still runs on it, and even with all the issues in China.
China is still the single biggest borrower by country. Emerging markets as a whole are over 35% of all outstanding dollar credit. It shows just how intertwined everything is.
So let's bring it all together. What does this mostly healthy private sector mean for the big picture?
The macro view from Trading Post is pretty clear. They think talk of a global recession is fading fast and that we're firmly in the expansionary stage of the business cycle.
And their core argument is that there are no major structural problems holding economies back.
Well, no problems in the private sector. They argue the real problem, the fiscal mess, is almost entirely on government balance sheets. The private sector, outside of corporate China, is fundamentally sound.
Which leads to some very clear investment advice. If private balance sheets are healthy and risk appetite is back, what's the move?
This is emphatically not the time to be holding bonds or playing defense. Trading Post is advising a switch into equities. They are overweight global equities, and especially U.S. stocks.
And what sectors do they like?
They favor industrials, which makes sense with a manufacturing upturn. They also like U.S. consumer discretionary stocks.
Which suggests they see inflation easing and consumer spending power coming back.
Exactly. And, not surprisingly, defense stocks in both the U.S. and Europe. On China, they're neutral overall, but they do see opportunities in some of the new generation tech names.
And for investors looking at the market right now, after we've seen a bit of a pullback,
Their view is that the U.S. market is ripe for a healthy correction, and their advice is consistent. This is a clean opportunity to buy on the dip.
so they see this as a chance to get aggressive, not a reason to be fearful.
That's their thesis. It's a moment to allocate capital into risk assets.
Okay, that's a deep dive packed with insight. The key takeaway for you, the listener, seems to be that despite all the noise, the private sector's health outside of China and the return of dollar borrowing points to robust risk appetite and continued economic expansion.
And here's a final thought for you to chew on. Trading Post asserts that the neutral U.S. interest rate is going to be materially higher going forward than it was in the QE years. So, if a higher cost of money is here to stay, does their entire bullish call this whole buy the dip strategy rely on the Fed never having to hit the brakes hard again? Is the whole thing premised on a future of benign interest rates?
Something to mull over until we meet again. Merry Christmas, Trading Post will be back in the new year.